All right, so up next, we're diving into a critical and timely topic. Models to markets, how climate risk is disrupting insurance and reshaping resilient finance. As climate threats grow and property values rise, insurance systems are feeling the strain. This session explores how the industry is responding and how innovations like better models can help protect both people and markets in a riskier world. Leading the session is Jason Jay, Senior Lecturer and Director of the MIT Sloan Sustainability Initiative. Jason teaches executive and master's level courses on corporate sustainability, sustainability-oriented innovation, and systemic investing. He facilitates strategic development for companies, organizations, and family businesses, building alignment and shared commitment to ambitious goals. Please join me in welcoming Jason to the stage.
Thank you, Jen. Good afternoon, everyone. All right, we're gonna have to juice this up, right? We're gonna have an hour and 15 minutes to talk about insurance. No offense to my insurance colleagues, but so good afternoon, everyone.
Good afternoon.
Okay, good, that's what we're gonna need. I am very excited to welcome this panel. The students, they put together an incredible program today. I have learned a ton from getting to meet these folks and get a chance to be a beginner's mind in this whole space of insurance and its role in helping us mitigate the risks of climate change. So I'm going to welcome the panelists to the stage, Karen Clark and Ben McNeil, Mike Gulla, and Dave Burt. What we're going to do is we're going to organize this panel in a couple different phases. So the first is that insurance is a complex space. And so we're going to try to do some basics about what is insurance and how does it work. In particular, what are the trends that we're seeing that are in part driven by climate change in constellation with other factors that are driving some major issues, some major gaps in the insurance space. And then we'll kind of pause halfway through and do some Q&A so that everyone in the room gets to ask some basic questions, like so that we can all kind of level up and get some orientation to how this space works. And then we'll dive into, okay, now we've framed up the problems here, what are the solutions? And we'll engage the panelists on the solutions and then have a second round of Q&A about the solution. So we'll take this hour and 15 that we have and sort of break this up. And then just the last little logistics note I'll say is that immediately following us will be Senator Markey. His arrival time, like with any political leader, his arrival time has like a little bit of uncertainty around it. And so we will be adjusting at the end accordingly. So first, I just want to get everyone's voice into the room and invite you to introduce yourselves. Just quickly share your kind of basic coordinates and how you come to be in a conversation about insurance and climate risk.
Sure. You're looking at me?
I'm looking at you to start, Karen.
All right. Well, thank you, Jason. And I'd like to thank the organizers for inviting me here today. I'm going to convince you that insurance is the most exciting thing that you've ever heard today. So I'm Karen Clark. I'm co-founder and CEO of Karen Clark & Company. Which is a catastrophe modeling company, although it's a little misnomer because we also now model all types of weather events, not just extreme events, and we also, of course, are modeling climate. And our role is a very important one in the insurance industry because catastrophe models are really the global standard technology for insurers and reinsurers around the world. This is a global technology to quantify, price, and manage risk. Normally it can be man-made perils, but normally it's natural perils. Mainly atmospheric perils, but also things like earthquakes. And again, you can have terrorism and pandemics, but we'll stick today, I think, on the atmospheric perils. And it's a really cool profession, and I hope some of you will ask me more questions about it. Our main office is right across the river in Boston, so hopefully you're interested enough that you'll come visit us sometime.
Perfect, Karen. Thank you. Ben?
Good afternoon, everyone. Thanks for having me here today. Ben McNeil. I work for Swiss Re. We're a global reinsurance company that provides reinsurance, traditional primary insurance, as well as risk management solutions to clients around the globe. I'm specifically on our public sector solutions team focused on North America. So we partner with public entities in the United States and Canada to develop risk management strategies, provide risk transfer solutions, and help with risk analytics as well. That's one of the things that our clients want to focus on. I've been in the role for about a year now, having previously spent about 10 years working for the city of Boston. So I was a former municipal risk manager, who they're now all my clients. So it's interesting to be now on the industry side and seeing the different challenges that municipalities around the country face, how they're similar to what Boston was dealing with, but also very different. Again, thanks for having me.
Thanks, Ben. Mike?
Yeah, Mike Gulla. To echo what the panelists have said here, I'm a career insurance professional. I've spent my entire career around the US working in the insurance space. I'm passionate about what we do and what we're trying to build, and climate is one of the biggest things we face as an industry that's going to impact society over time. I founded Adaptive Insurance about a year and a few months ago, and our focus is really on helping businesses build financial resilience in the face of climatic events. So we don't look at just climate and how climate catastrophes are actually, impacting small businesses across the country, but really around how the changes in weather and the changes in climate on an everyday basis are actually impacting consumers, habits, the different things that are there. So we focus on building parametric insurance products that bring significant value immediately after an event takes place, while at the same time helping those businesses build financial resilience. So this is going to be a great discussion based on the conversations we've already had, and really looking forward to it and excited to be here.
Great. Thanks. Welcome.
Yeah.
David?
All right, Dave Burt, founder and CEO of Delta Terra. Thanks to the organizers for having this event and inviting me. So I bring a little bit of a different perspective. I am not an insurance expert, although I am sort of applying some beginner's mind to the space as I work on our application, which is taking any understanding we can glean from the insurance as to the actual costs related to climate change and global warming for property owners. And actually pushing that through the various impacted capital markets that support real estate. So my background is as a mortgage-backed securities investor. I've worked at BlackRock, Blue Mountain, and Wellington Management most recently. The idea in those roles is always to find cheap things to buy for clients and rich things to short and generate alpha. And there's a lot of mispriced stuff out there around this specific theme that we're going to be talking about today.
Great. Thank you. So what we've done as a group is put together a couple of slides, and we'll switch over to that other slide deck, that just help illuminate what's the state of play in the insurance space. And I'm going to walk through these and then invite our panelists to comment on it and use this as an occasion to share some basic facts and insights about the insurance space that folks may not be that familiar with. So the first is, this is a graph that is that categorizes the billion-dollar disasters. So the y-axis is the number of events that cost $1 billion in any given month of any of these different years. And so what you can see here is that the black line is the average over this 1980 to 2025 period. And you can see that the recent years, which are highlighted with the colorful the lines above, are well above that average, right? Reflecting that we are seeing more and more kind of billion-dollar level events every year. This is data up through 2024, so it doesn't include the Los Angeles wildfires, for example. So there is an increase in the sort of cost of these damages. And just to have a sense in the United States of what that looks like, it's a mix of hurricanes, tornadoes, hailstorms, major winter storms, flooding events, and some wildfires, which all of which have some damage to property, some of which might be public sector property and the client base for Ben, some of it is homes and businesses and privately owned infrastructure. When you have more and more costs that the insurance companies are having to pay out, some of that cost is passed on to consumers or to purchasers of insurance products, i.e. the premiums that are paid. And so the average premium in homeowners insurance has been going up. Now, this is not, just look carefully at the y-axis. We're not talking about orders of magnitude increase. The scale on this graph is from 1750 to 2500, but the shape of the graph is pretty alarming in terms of the increases in premiums. And that that adds to affordability challenges with housing that we were discussing earlier downstairs. And then as premiums are increasing, the other tool in the tool belt of an insurance company is to just not renew a policy if they think that the property is in too high risk of an area. And so we're seeing non-renewal rates that vary across the country, but what you can see is that some of the areas that are impacted by the hurricane risk in the Southeast and wildfire risk in California are among the regions that where we're seeing some non-renewal of coverage. And so that means that I have an insurance policy on my structure, and now the next year I don't have an insurance policy on that structure. The areas with greater fire risk have higher non-renewal rates. The areas with greater hurricane risk have higher non-renewal rates. So it's the structures that are in these more vulnerable areas that are then losing their access to insurance through at least some mechanisms. And then as a result of that, what that means is that if people aren't getting insurance, it means that there are economic losses from these various different events that are not being repaid by insurance. And so in any given year here, the gap between the red bar and the blue bar is the gap of of what is actually insured, the economic losses versus the insured losses. Ideally, if people were able to make themselves whole with that insurance payout, the blue and the red bars would be closer together. And so there's a gap here. One of the things that then comes in to fill the gap is what are called insurers of last resort. Insurers of last resort are public or quasi-public entities that provide some form of coverage when the market will not. And this is just a little snapshot of the market share of different insurers in the state of Florida. And what you can see towards the bottom of the list is that Citizens Property Insurance Corp is now among the top 10 insurers in the state of Florida, and that is one of these insurers of last resort. The green counties marked on this map are the places where that is most active. And so we're seeing that, in a sense, the public sector in various forms is picking up some of the bill of coverage. Now, there's tremendous nuance behind all of these, but we wanted to share what are some of the pieces of data that folks are paying attention to as they think about the risk management system that we have, the financial risk management system that we have around climate risk. Now, I am a total beginner, like I said, when it comes to this insurance stuff, so I may have misspoken or overspoken, and there might be all kinds of nuance behind these pieces. So what I want to do is just invite some editorializing from the panelists, some critique of anything that I just said, but also any nuance that isn't that's behind and driving some of these phenomena, but which may not appear to the naked eye. Let's see. Karen, do you want to get us started? What jumps out for you as the things that you would want everyone to know about?
There's a lot.
What we've just seen.
So I think I'll just tee up a few things because if I
we can come back to you, yeah.
We'll come back, but there's really a lot to unpack. Actually, can you go back to the slide that shows the economic versus insured?
Yes.
One of the things I did want to comment on that is that's global. Okay, and there are a lot of regions in the world that don't have a lot of private insurance. So if you just did US, they probably wouldn't be so far apart, except floods. Floods are not highly insured. So you get a lot more economic loss than you do insured loss. So I did want to point that out, that it's global. But I think there's so much to unpack here. It's hard to know where to start, but I think I'll pick on the increasing premiums.
Okay.
Because one of the things that people just don't understand, and it's really the insurance industry's fault, that they're really terrible at explaining how they do, what they do, why they do it. So your premium is basically a rate that reflects the risk, or is supposed to reflect the risk, if you're a homeowner, times the replacement value of your home. And guess what? The cost to build the same single-family home over the last 10 years has doubled on average. So right there, if the insurance company does nothing with the rate, your premium has to double. And what are we building today? Like when we go back, let's say to 1990s, you know, what were we building then? You know, we were a house was a rectangular box, you know, with a one-car garage, maybe two. What are we building today? You know, very complex structures, more expensive, marble bathrooms, marble kitchens. So the biggest driver, there's one thing I could start with, when you see increasing losses on those charts,
Or even the number of billion-dollar events.
or even the number of billion-dollar events, the biggest driver on that is demographic shifts, moving into more hazardous areas, more people, bigger properties, and the cost to repair or replace those properties, because that is what insurance companies have to pay. And as you mentioned, you know, insurance, it's a product, you know, like anything else. If the price of milk ingredients go up, milk is going to go up, you know, it's just, if your ingredients go up, the cost, then the price of your product has to go up. So there are impacts of climate change, but we can come back to those. They're very nuanced and they differ by peril. But if you look at those charts, still the biggest driver is increasing in what insurers call exposures. The amount of property that is exposed to damage. And we love to build right in, you know, Mother Nature's way. You know, we like to just...
Right, it's like, well, it's nice to
Mother
be on the
Nature.
coasts, and it's nice to be in
Exactly.
California, right?
Exactly.
So it's
So I'll just tee up that, but there's a lot more to talk about.
Okay, so so this equation that you're describing is that that these premium type numbers are property value times the losses, and the losses are kind of the magnitude of the event
Well,
times
it's
the frequency.
rate. So,
the rate.
yeah, so and this is what comes from the model. So insurers, they have to project for the next year what they think their losses are going to be. So that is a ratio of the loss, the expected loss, divided by the value of your property.
Okay.
And that's called a rate. So, and that's what, you know, people think is going up, and it is going up in certain areas for sure. But that's kind of the formula. And I wish every insurance company would put that in, you know, the start of every homeowner's policy, which of course nobody reads their homeowner's policies,
Right.
including
Nobody would
me,
look at it.
because it's impossible.
Thank you. Ben, do you want to add something here?
Sure. Maybe I can just speak a little bit about how this is manifesting as a problem for public entities, and how we are working with our clients to sort of figure out what are they doing with the challenges that were presented. So for the most part, we work with municipal risk managers, maybe the budget office or the treasurer or the CFO, and their job is to figure out how to manage this risk. And one of the ways, and we can just focus on sort of property for the context of this conversation. One of the ways that you can do that is to self-insure. So you may hear that concept, but the idea is that the entity, so in this case the municipality, would sort of do calculations to sort of assess what these potential losses would be and figure out budgetary mechanisms to sort of cover the losses by themselves, essentially. They can also go to the private markets through risk transfer. So very simply, they can go out and buy traditional property insurance. Or sort of the third traditional leg of how municipal risk management has functioned for the past 20 years or probably longer, has been a reliance upon the federal government. So FEMA will come in for these sort of larger natural catastrophes with a federal disaster declaration and provide or administer a program called public assistance. And this is a way to public entities to recoup specific losses for an event. For a long time, that those three different options sort of work. Now, different cities, maybe they completely self-insure, maybe they buy a little bit of property. They're all relying upon the federal government. That worked, but if we go back to just the rate of sort of billion-dollar disasters, that equation is no longer functioning. And so municipalities are now having to think about how they're going to better manage their risk and think about maybe it's an alternative risk transfer solution, so looking at capacity in different markets, and also making sure that they are managing their risk and reducing their exposure. So, one of the challenges is very simply, how are we going to financially manage the growing risk to the assets that we own as a city? But I think the next level piece of that, and this was something I was dealing with when I was the risk manager for the city of Boston, is if we're going through rising rates and we're seeing, pressure from carriers, we can assume that those same impacts are being felt by our constituents, and that our residents and our businesses are going to be having issues with purchasing property insurance and rising rates. That protection gap that Jason mentioned is a problem for, in managing cities' own municipal assets, but it's a real problem for the residents and businesses and what that ultimately means for municipal budgets. So if we have an incident, for instance, in the city of Boston where we have this large protection gap, there's a lot of uninsured losses, what does the recovery look like for our city? And then ultimately sort of what does that initial recovery look like, but what are the long-term implications, right? Is there going to be an impact on our property tax revenue? Is it going to draw people to maybe think about leaving the city and ultimately sort of create some additional fiscal impacts? So, from what used to be a pretty simple, I don't want to say simple, but traditional process for how we were evaluating risk and buying sort of traditional property insurance, now it has become much more complicated, and the job of a municipal risk manager is becoming that much more challenging in this context. And certainly, with the change in administration and thinking about federal support, that is another layer of complexity that municipalities are all struggling to sort of figure out, what are we going to do?
Okay. And if you're running a book of insurance or you're self-insuring, part of what you need to keep an eye on, if we follow your equation, is the sort of property values, and part of what you have to keep an eye on is what do we expect the magnitude and frequency of these events to be. So you mentioned you're involved in modeling. It sounds like that modeling might play an important role. Like, do the municipalities have the capacity to do that modeling themselves? Where do they engage with others? Like, who provides some of the kind of view on what the future holds?
Yeah, so it would depend on the municipality, and some may have more sophisticated in-house capabilities, depending on budgets and ability to retain talent and hire for that specific need. But and this is what I found. So I came from an emergency management background. I was the director of our emergency operations center, and I was blown away by the information that our property insurance program was essentially telling us about our risk, and what our brokers were able to tell us about sort of probable maximum loss for our certain properties. So that is sort of the first conduit, I think, for a lot of municipalities to think about the risk analytics that the insurance industry has is through their brokers or through their carriers. But that is definitely something that often needs to be asked and not always told, and I think that's something that can be further teased out or improved upon in terms of this overall sort of risk management for a municipality.
Okay.
Yeah, I would just agree with that most of the models are licensed by the brokers, and then the brokers will provide it to municipalities versus them licensing the technology directly.
To help them just know even how much insurance to take out, and sort of in the sales process. Okay.
Yeah, I will say one other thing about the model. So you made a good point, like how much to buy, because it's not just the price, but insurance companies, municipalities buy insurance, you buy insurance. Insurance companies also buy insurance. It's called reinsurance, because if a major hurricane happens, even State Farm, I mean, for Hurricane Andrew, State Farm did go insolvent technically, but the auto company came in and saved the property company. So they did that. So they also, that's a really important point. Use of the models is for insurers to get the probabilities of losses of all different sizes. So they buy their own insurance, and municipalities use that information as well. So that, because the last thing you don't want your insurance company to go insolvent after an event, or then you will have a problem getting your.
Can I break in with a question?
Yeah.
So that was 1994, right?
Andrew?
92.
92.
92. What would that cost today, and what would the insurance?
Yeah, that's actually a
capacity
great
handle?
point because it gets to my point before. It was $15 billion at the time. We estimate it will be almost $100 billion today because of demographic changes, cost changes, and that is just the insured amount. Now, Andrew was highly insured. Again, it was mainly wind damage, and wind damage is pretty much insured by the insurance industry. If you have a flooding event like Helene, that is very low. But to answer your question, that's how dramatically it's changed. And that's also why, another point I want to make, when you see those charts with the trending, you have to see where they start. Because I think that chart, did it start in 95?
This one here?
No, the one
With the premiums?
I think it's in the beginning. Go back one. No, maybe you don't have it in here. I thought you had it. But when you see these increasing losses, if they start in 95, they're missing Hurricane Andrew, which would be a $100 billion spike. They're missing storms. The worst storm, if it were to occur today, little trivia for you, the worst hurricane, if it happened again, historical hurricane, will be from 1926. Okay, that was a great Miami hurricane, Category 4, that made a direct hit on Miami. In 1926, very few people lived in Miami. Today, that will be over $250 billion. So actually, for hurricanes, the US has been lucky because most of the events have not hit populated areas, highly populated areas like Galveston, Northeast. We haven't had a return of the Great New England of 1938.
Okay. Mike, if there was anything that you would want a general audience to sort of know about this space of insurance, what would it be?
Yeah, I would say everything that we've talked about and everything you've heard about today, all of this I think comes back to culminate around resilience and investment in resilience, right? Regardless of, if you take away the reasoning behind these things happening, increases in premiums, whether it comes from climate, whether it comes from people migrating to different parts of the country, the ultimate fact is that the insurance industry needs to find ways to mitigate these losses. We need to figure out ways to get communities, property owners, business owners to invest in their own financial resilience as we grow. We have amazing technology. There's great groups within insurance, the Insurance Institute for Business and Home Safety, which is a great group that has spent a lot of time and effort and money understanding wildfire risk, wind risk, earthquake risk, and other things. We know how to retrofit properties, right? Homes have changed a lot over the years and people have invested in different things, but not resilience, right? If you give a homeowner money to spend on their property, they'll buy a new TV or a new couch. They won't put a hail-resistant roof on their house, even though in the long term that would have a much better benefit. So a lot of the things I think, Karen, that your company does around modeling that I haven't seen a huge shift in insurance and would love to see this from the educational community in the US is the offset of what those losses would look like if we actually all collectively found ways to invest in resilience and found ways to incentivize communities to actually insure their losses and found new product ideas like parametric insurance and other things that we're going to continue to talk about today that will ultimately incentivize more resiliency in the markets, which in turn drives a lot of these costs down regardless of the reason. There's no argument about whether or not the Earth is getting warmer or whether or not climate change is real or unreal. It's all, we know what we're paying out at the end of the day, and finding ways to limit those payouts is really what the industry should be focused on. And that's through investment, which is a very, very hard thing to get people to do, especially at the consumer level.
Okay.
Yeah, and could I just add why it's doubly hard? But that is one great use of the models, is determining mitigation credits. Yep. Like if you do put a hail-resistant roof, you get a discount. So you get a discount, but again, the discount is on the expected losses, which are amortized, over 100 years. So the reduction in the expected loss may be, $500, but the roof costs $20,000, so it's hard. But I think this is where, governments and insurers need to kind of work together because I know, and so homeowners need assistance, in building more resilient properties because it's going to cost more. So in Florida, they did a really great thing is that they gave either no interest or very low interest loans to homeowners and even grants to some owners to harden their homes, to build into some of these features because the insurance industry does give credit, does give discounts, but they're just not big enough really to make a difference. And the other thing, state and local, and again, homeowners don't like this, that there's a cost, but enforce and make better building codes. As you said, IBHS, we know how to build homes that are more resilient, but it costs more. And so there's always the contractors, the building industry, the real estate industry, they're all against it. There's a lot of
So there's some
better building codes.
So there's if we're just getting the facts out into the room, right? It's like there's an interdependency between what the insurance industry is doing, what the regulation of the insurance industry is doing, and also other adjacent things like building codes and so on, which we'll get into more when we start to talk about solutions to these challenges. Dave, is there anything about kind of the insurance space or the risk management space that you just want to level set in our audience here?
Yeah, maybe just a couple quick things from, again, from the capital markets perspective. I mean, the big question for how is this going to affect investments and investment markets is, that's a pretty big gap in liability when you look at it, just dollars and cents.
You mean this coverage?
Yeah. So that's
global,
like,
right?
who's paying for that, right? That's the question, and what investments might have to pay for that if you reach some point of fatigue where it was unsustainable to continue in this manner. I would suggest that we probably passed that point of fatigue in 17, 18. I mean, PG&E was probably the first climate bankruptcy. We're at this point now where that's really the question that we try to answer is, okay, that gap isn't sustainable. It needs to close. Where did it come from, and who's going to have to pay for it going forward? And just really simply put, there's so much complexity in the insurance scheme. It's pretty difficult to pull it apart. But one thing is really kind of basic when you're thinking in terms of markets. Insurers reprice and re-underwrite 1 year at a time. So when you think about who's going to have to pay for this gap, it's probably not insurance companies. So this is just something that people kind of get wrong. They think, oh, well, this is an insurance company problem. I should worry about my insurance stocks. Honestly, growing risk is like an opportunity for insurance as long as they're allowed to price it right. So I would just suggest that it's property that has to bear these costs over a very long time horizon. So just like that comparison of that $500 a year for a $20,000 resilience spend. I mean, that's really the ratio of annual cost to long-term risk. So you're thinking 40 times if the annual cost gap a year, which we estimate just between wildfire and flood, which are clearly being influenced by global warming, and at about $40 billion a year. So that translates to just closing that gap in today's market. If people were actually pricing that into asset values today, and that's just for the single-family home market, that's at least a $1.2 trillion hit to asset values.
Yeah, and Dave does bring up another, go ahead.
No, I was just going to add one clarification. I think you'll probably chime in on this as well. So in the insurance market, you also have highly regulated markets across the US, right? Over 50 different jurisdictions. So while we do price on a yearly basis, at many, many points in my career, we've had a rate indication that could have been more than 25 or 30%, where the regulator comes back and says, you can take a 5% rate increase this year, you can take a 7% increase next year, and then a 10% the year after that. And by that time, my indication has already changed 3 times over, right? So you have this compounding effect that regulation also has on the amount of premium. We see this recently with State Farm, with everything that's been going on with the wildfires in California. So there are so many different compounding factors on top of what we're trying to do from a pricing aspect, which is why, again, the resiliency and the investment around how do you reduce the total amount of loss so that we don't have as steep of a price indication need to make up premium dollars for the amount of claims that are being paid.
Yeah, I'd like to chime in on both of that, because that's right, because that gets to your non-renewals. Okay, there are 2 reasons why insurers non-renew. One is if they think they have too much exposure. Again, they're going to go out of business if there's a big, that great Miami hurricane hits again. But the second reason, which has been brought up twice, is they can't get the right price. Okay, there's a saying in insurance, there's no such thing as a bad risk, there's only a bad price. And because of regulators, a lot of regulators are elected officials. It's a political office. They have to please their consumers, so they try to hold the prices down. Again, you said you had a 20% indication, you could only get 5. So basically you're saying for my product, I can't cover my cost. So what happens is that is where insurers are non-renewing. That's happening in California. Like California, believe it or not, does not allow the models to be used in California for wildfire because they think the prices are going to be too high. And it's really silly. They want to use on historical data, but for wildfire, that's completely backwards because after you've had a fire, you're less vulnerable because the vegetation is all gone. So really, that is a major problem, is that insurers cannot get the true risk-based premium or the risk-based rate in certain states. Actually, Florida's done a great job. They have they're really on top of it since Andrew, and they do a better job. But and it's 50 different states, so insurers have to deal with 50 different
regulatory regimes. Got it. Okay, let me pause here and just get any clarifying questions from the audience so far. So not about sort of solutions yet, but just in terms of getting our heads in the room and into this conversation. Is there any and there's no such thing as a dumb question. If it's on your mind, it's on someone else's mind. Anything that we haven't covered here in terms of the basics of this situation, understanding the problem? Yeah, in the back there.
I guess you did mention this at the end, especially with the data, the historical data. And this is more on the global scale. How do you go for fixing for gaps in data? So I'll give you an example. A lot in agriculture, they're facing low crop rates. They're facing unprecedented pests and other things. So how do you go about pricing the premiums for agriculture and other industries that are heavily impacted by this, but without the data?
Yeah, okay. I'll jump in to answer that. Well, first of all, the whole reason that catastrophe models came to be is because of lack of data. Because again, the first models were hurricanes and earthquakes. Okay, so we have a real lack of data, for example, on major earthquakes. So again, we can't go into detail here, but the models are based on, like our team is a bunch of, atmospheric scientists, seismologists, people who are like way smarter than me. And so you need to use the data you have, but also scientific expertise. And you really need to build that into your distributions. And then the way the models work is you use statistical analysis where you can, you supplement it with expertise, then you generate a large sample of scenarios, if you will, millions or hundreds of thousands of potentials. And then again, you validate, you try to, does it make sense? Does that make sense? And then if you're happy with that, then it's not perfect, and you improve it over time, but at least it gives you a framework. The modeling framework is really why it's so powerful. And because it has all the science, the engineering, the exposure. For agriculture, there may be other things, that you have to put into it, but it's really a very rigorous framework. So you're explicitly dealing with that lack of data, So I hope that answered a little bit.
I would add one thing too, just from a pure data aspect, and obviously sitting on MIT's campus, you guys are no strangers to this, but the amount of investment into data and technology and the advancement that we've seen in the last 5 years is unlike anything I've seen in the insurance space in the last 20 years. Right, when you can have a company that can launch their own satellites via SpaceX now and actually start to create their own weather models that have just so traditionally been used by NOAA and NASA off of the same type of ideas and the same type of methodology, you're going to get this new influx that I think is going to change a lot of the models, hopefully for the better because you're just going to have more access to more relevant data, more pinpointed data for the certain types of things that you ultimately need to price. So hopefully we see that it becomes less of a data problem, it becomes more of a scientific problem of how do we come up with the solutions of where the investments go and combining those things together.
Great. Other questions from the audience? Clarifying? Okay. So let's get into the space of solutions. And what I want to do is, so we talked about insurance as being in this kind of ecosystem. So I want to sort of organize this first in terms of what insurers can do to help promote adaptation resilience to these climate risks, and then go to what can the industry as a whole do through collective action. You talked about some of the industry level associations. And then what can regulators of the insurance space do to kind of change the rules of the game to maybe encourage supporting resilience? And then what are the other actors that, you mentioned building codes and other things that have a role to play. So just so we can kind of understand the solution space and what you guys are each innovating to develop. So maybe we'll start with kind of individual kind of insurance companies. What's on the table as far as new ways to go about either closing these gaps or encouraging more resilience. We talked about, you mentioned parametric insurance at one point. We have to define what that is, but we'll get a couple of those different ideas into the room. So maybe we'll start well, actually, the first one that you mentioned, Karen, was the idea of discounts, right? So discounts and credits. So that's one thing that's sort of on the table, right? Is if you do this thing that lowers your risk, you won't have to pay as much in a premium. So that's one sort of mode of incentive. There was a question that came up on Whova about can they just help fund these sorts of changes if it's going to reduce my risk, use the revenue to reduce it. I don't know if that's on the table or not, but what are the different mechanisms that you have?
I like to give this example. So when I was with the city of Boston, our primary property insurer was FM Global. So they represented our whole property stack, and as part of their business with us, they would take a look at our most valuable assets and those at most risk and run a loss control engineering report for those facilities. And that would sort of tell us sort of what we were at most at risk for and what we could do about it. What were the investments we could make to reduce that risk? And there was an idea that if we made investment X, it would result in a premium reduction. And so one of those insights that they helped us discover, because this was not something that we had known on our own, was that at City Hall on our Congress Street entrance, there was a large flood exposure directly at our where a lot of our IT infrastructure was located, and they said, this is something you need to shore up. This is a problem. We want you to go about and fix it. So we did. We invested, the city of Boston, so it was not something that FM gave us any money for. But we made the investment to sort of reduce that risk, and ultimately that lowered our risk according to FM. Now, to the point earlier, the risk is one part of the premium pricing, and so I think we have to. I think it's hard to get to these moments of like, if you invest in risk reduction X, it's going to result in premium reduction Y, because there are so many other factors that go into how your premium is calculated. So for this specific example, maybe our premium did go lower because of this risk reduction investment, but then we had a really hard market, and we had inflation, and we had interest rate increases, and we had supply chain issues. So ultimately, our premium went up, but maybe less so because we made this investment. So I think that's a really interesting example to explore. Now, the reason that worked, though, is because FM was our primary carrier, right? They represented our whole program, and there was an alignment of incentive. Shortly thereafter, this project, FM issued a notice of non-renewal. They sort of broke up with the city of Boston, and our property program was then, I think, about 10 or 15 different carriers, and they each had a small portion of risk, and ultimately there was less of a sort of alignment of incentives, because they were like, look, we all have different versions of risk. We think it's different. We think it's different. It's aligned. It's different. And there was less of sort of an opportunity to explore these sort of risk reduction investments and how that would impact overall pricing. But I think that model does exist, and it's figuring out ways to sort of tease that out. Lastly, I'll just say that I think state insurers of last resort, I think they're doing some really innovative work in this space. I would look to Alabama. North Carolina and their FAIR plans have worked with the Department of Insurance. They've worked with labor unions to sort of figure out how they can, because they're arguably insurance companies, right? They've been able to figure out how to directly price in some of these risk reduction benefits. I think the fortified roofing standard is probably the more classic one I'd encourage folks to look into. And they've been able to work that into their models and incentivize and help pay for some of these adaptation investments that ultimately result in a lower risk for their customers.
Yeah. I could chime in a little on the homeowner side, but it's not, they're not funding it, but you reminded me that, and somebody talked about technology that, now with all the aerial imagery, so a lot of insurers are buying like images of your rooftop of your home. And one of the really bad things for your home is if you have a lot of trees and tree limbs hanging over your house. Because the way houses get damaged in windstorms is a tree falls on your house or the limbs. So they have, a lot of insurers will send you those images and tell you that, this is, something that you should be doing. It's not always a positive. It could be like a non-renewal if you don't do it, but it is more, educational to try to get homeowners to mitigate. Or if your roof has mold on it, you have an asphalt shingle roof, it has mold on it, they'll show you that this isn't good, if there's an event. So I think in general, insurance, it's hard to, again, give somebody like, here's the money it's going to take to replace your roof. I think, we mentioned these are annual policies. Perhaps if we had like 10-year insurance policy, you are going to be with this insurance company. But the problem insurance companies have, if they give you, a real break and say, I'm going to help you pay for it, you could just drop them the next year and go to another insurance company. So there's no like long-term relationship there for giving a lot of help, if you will, in paying for some of these things. But the insurers are paying for the aerial imagery. They are, I believe, giving it to homeowners and hopefully using it to, again, help in mitigation.
I'm just thinking about how we always talk about planting trees as a way to create shade cover and reduce energy usage, and that's kind of mitigation adaptation benefit, right? But you're saying just make sure the limbs don't go over the roof.
Exactly.
Access.
Mike, what is?
They have to be far enough away.
Yeah. What is parametric insurance?
Yeah, so for us, parametric insurance is actually very easy. It's been around for a long time. A lot of folks think that it's this new thing in insurance, but it's been around for many, many years. And it's essentially a loss that's triggered off of a specific event, right? So think of one thing happening. It could be a wind speed. It could be a duration of a power outage. That is your parametric trigger point, right? Let's call it a 12-hour power outage is your parametric trigger. And you're a business owner, and if your business shuts down for 12 hours, you lose $15,000 in revenue. That's the coverage limit that you buy, and now you have a 12-month policy that would cover you for that type of event. The uniqueness about parametric that actually got me very excited about it when I originally started working on adaptive and what we're building and bringing to the market was this idea around resilience and helping businesses around the US understand what their exposure is to climate-related losses. And while at the same time helping the insurance industry somewhat diversify themselves out of just pure cat exposure. So if you think of power outages in the US, a lot of folks think of what happened with Hurricane Helene last year, or what happened with Super Freeze Uri that hit Texas a few years back, which obviously are huge events that shut the power down for a long time. But the impact that you actually see on a daily basis of power outages across the US is actually much shorter in duration, less than 24 hours, which is actually the area where the insurance industry as a whole does not insure. The trigger point on most commercial policies is after 24 hours. So when you include a new product like a parametric product, it actually brings new premium dollars into the insurance market. It helps to diversify the risk exposure, and it ultimately gives the end consumer or business access to a product that will pay them quickly after an event, usually within 24 to 48 hours. And the beauty of it, from just a pure underwriting standpoint, and saying this as a career underwriter, you take the human element out of the policy. So I don't have to underwrite the moral hazard that we usually have to underwrite of who is the person at this house, or who is the person behind this business? What does their credit score and financial rating look like? How many claims have they had throughout their insurance history? None of that matters on a parametric product, especially in the climate space, because I'm building your rate based on the likelihood of your physical location being exposed to the event that I'm trying to cover you for. So it's a smoother transaction, and when the policy actually triggers and pays, unlike traditional insurance, I'm not giving you money and telling you you have to fix X, Y, and Z like you would on a traditional policy. A parametric payment allows you to get access to capital quickly that you as a business owner can now decide how you need to use it best for your business. In some cases, it could be paying your employees. In other cases, it might be that you decide to invest that money because you had good financial, resilience already and you had been saving knowing that this event could happen. It impacted you, but not to the extent that you thought, so you now invest that funds into future resilience to the next event that could impact you. So for us, the idea of this is really coming up with new ways to bring in new premium dollars, bring in new partnerships, and create new opportunities for customers to access products that drive a different type of value than they would get from a traditional product.
Really interesting.
And we've seen parametric adopted by municipalities across the country, and they're using it for a variety of ways. So one, they're attracted to it because, as Jason was just saying, the speed of which a payout happens is so quick in comparison to what a traditional indemnity policy or even what the FEMA public assistance program can be. We've had clients where we've issued checks after a hurricane within 72 hours, right? And all of a sudden they get this check and they just don't know what to do with it because they don't believe it's actually real. But what that can do, and to Jason's other point, is that money can be used however the municipality.
Mike's other point, sorry.
Oh, sorry. Then what can be happen with how that money can be spent is however the client sort of sees fit, right? So we talked about the sort of protection gap for municipalities. There are a lot of uninsured costs post-event that aren't covered by traditional indemnity or covered by public assistance. And now they can go figure out exactly where they want to allocate that liquidity that they just received through this parametric product. So we're seeing it used for deductible buy downs. We're seeing it used to address capacity issues, or we just sold a deal in California for a flood parametric. So it's a really innovative tool that I think risk managers are using to diversify their risk management strategy. I'll conclude to say sort of the last piece of innovation in this space that municipalities are exploring is sort of thinking about taking out a parametric policy on behalf of residents. And so the idea here is, we talked about the protection gap of residents and what do we do as a municipality to support the businesses and residents after an event. We've ran a pilot in New York City where essentially I would look at, there's a great reports on this actual pilot, but I'll give you the truncated version. But the city took out a policy on behalf of residents for a flood event. And so if this event were to happen, there would be a quick injection of capital to a nonprofit that would be able to disperse grants of up to $5,000 to residents to help them in their initial recovery. That is like a game changer in terms of thinking about emergency management, disaster recovery. Those mechanisms do not exist. And I think there's a real future to see how those products can further support the increasing financial resilience across the country.
Interesting. One thing, Dave, that we were talking about before was that insurers aren't just a book of policies and claims, right? They're also major asset owners. They take in the premiums and they invest that in the markets, and they're very substantial asset owners. In their investment book of business, are there things that we should be thinking about here in their role in this resilience space?
Well, yeah, it's interesting because you're talking about having conversations with both P&C insurers and life insurers. All insurance has these two books of business. So they generate earnings both from collecting more premiums relative to what they pay out for claims, but then they're also taking all that reserve money and investing it. And I think actually the earnings of an insurance company is generally pretty well balanced between those two businesses. Ultimately, because of their risk profile and how they're regulated and how they have to retain capital, insurance companies end up being some of the biggest investors in real estate. So I've seen it estimated that about a third, and life insurers are actually the most exposed.
Yeah, I would say life, because property is more short tail, so they would have more liquid assets.
Exactly.
So it must be life is more.
So yeah, exactly. So life has very long, they look almost like an endowment investment portfolio.
When these shades are up, we can see the Prudential Tower and the Hancock Tower. It's not because those are full of Prudential staff and Hancock staff, right? It's because those are...
You own the buildings.
They own the buildings.
Right. So about a third of life insurance assets are real estate related. So beyond the PNC liability and an insurer, they've got a lot of money invested in real estate, which ultimately, again, our thesis is that it's property that will end up bearing the costs of these increasing liabilities.
So it's a vulnerability to the insurance industry of climate.
Yeah.
That we don't think about when we just think about that side of things.
Yeah, and I won't even get into mortgage reinsurance, but that's another one.
Yeah. Let's go from individual insurance companies to what's possible through the industry and collective action. So you said, you mentioned the IBHS earlier. Would you say a little bit more about what that is and what's possible through that type of mechanism?
Yes, so I've actually worked with IBHS for a number of years when I was with Nationwide Insurance on the East Coast. They have an incredible facility in South Carolina that they can actually create 150-mile-an-hour winds. They can build full-size replicas of houses, and they blow them away. They burn houses down, and they've done a tremendous amount of research to understand what the impacts are and how you can actually fortify a home. The IBHS is completely funded through the insurance industry. It's a nonprofit, right? So you have a lot of insurance companies that have invested tens of millions of dollars into these solutions. Their fortified home program for hurricanes, as you know, as we talked about and Karen, you mentioned, is an incredible program. Like a house can be fortified to withstand a Cat 5 hurricane on the coast and have almost no damage whatsoever.
And they have a wildfire one now.
And what the wildfire one, they have a hail model, and they've figured out how to actually build the slope of a roof with the proper type of roof shingles that connect, which gets to a tree touching a roof is usually not the issue of the tree itself, but the tree creates an entry point on the roof shingles, and then the 70-mile-an-hour wind now has an access point to rip the entire roof off and cause a whole bunch more damage. So we have the technologies. We know what it costs to actually invest in these things. They have a lot of things that show you exactly how much money it can do, but the discounts you get on your home insurance aren't going to offset that cost, or your business insurance. You need new ways to provide the capital into the markets to actually incentivize folks to invest in these things. No homeowners, and most Americans obviously have such a small amount in their savings account, they can't afford to invest in what they need to invest to, even though they're the ones who are actually facing the brunt of climate change and the brunt of what these losses are doing when these events, impact them at the ground level.
Or we have to have just a different mentality on what we're building.
True.
Because again, what is the average cost now for a single? I don't know, it's like $350,000 or something. But again, what are we building?
Yeah.
So do we put it in marble countertops or do we put it in storm shutters? So
but the hard part
is a choice there.
The hard part is, and I use this analogy with a lot of folks, if you look at the auto industry versus the home insurance industry, and the home industries, vehicles turn over very often, right? The auto industry is always updating their technology. You can't buy a car now without a rear-facing camera because it's legally required to be in every new car built after, I think, 2013 or 2015. Homes don't turn over, right? So on the new home builds, I would actually say, from my time at Hippo, Lennar Homes was an investor in Hippo Insurance where I used to work, and they build more new construction properties in the US than any other home builder in the country, and they do invest a lot of new technologies and a lot of things in the home now to try to make them at least somewhat more fortified, understanding fire-wise communities and where they're actually building the communities to help consumers understand. The problem that I've seen in a lot of areas in the country that I've lived is the inventory of homes in this country is also old and not upgraded. Most people don't knock a house down unless you're in California and try to rebuild it, right? So you have to retrofit that house, which makes the investments much more expensive to do as a retrofit than it is to do at the time of new construction. But I agree. I think we've seen from Florida as the greatest example of the Miami code updates that they've enforced over the years have had a tremendous impact on the sustainability of properties.
Absolutely. I mean, and I agree with everything that you said, Mike, although I do think they have to be required. Like the local and state government have to say you have to build to this code. You can't make it optional because.
And ultimately, insurers, my industry, my company, we love building codes. We love, fortified standards. And I think that's sort of one thing I think I want to clarify today is, when we talk about non-renewal, that is a risk management strategy that our industry does use. But ultimately, we want to stay in the business of writing premiums, and we want to be able to stick with customers long term. And so the ways to do that is by deploying capacity in risk that we understand and risk that we think is lower, right? So we have a ton of capacity deployed in places that I think people, are assuming we're exiting, but it's actually because the risks that we are writing in those spaces have incredible building codes that certain states, counties, municipalities have passed. So I think there is sort of an incentive is there, right? The industry will deploy capacity when those things exist. Arguably, we could be doing a better job of indicating what those things are that we like, but that model does exist and it just needs to be expanded.
Yeah.
Yeah,
And I think
We got Dave, and then I'll come back to you, Karen.
Yeah.
I was just going to add to that. I mean, we kind of highlighted the main problem, right? You save $500 a year and you spend $20,000. So it's like, who's going to pay? And I think there's a couple different things. I mean, we've talked about incentivizing people to do that, and who does that benefit? Well, it does probably benefit the insurer bottom line, like at the end of the day. So I think we have started seeing some insurers, even on the investment side, start thinking about providing financing to programs like low interest financing for resilience. So that's one thing that can come through. From the mortgage industry perspective, it's a big part of the issue. And honestly, it's about signaling and communication. Because right now, for instance, we mentioned the biggest gap is in flood insurance. Or we didn't really get to that, but I think the biggest gap, and Karen mentioned in the US, that is one where there's a pretty known gap. Flood insurance is only required to get a mortgage if you're in one of these FEMA-defined special flood hazard areas. And those maps are political, they're old, they're not that useful. And so most people will just say, well, if I'm not required, then I probably don't have that much risk because Uncle Sam's not worried about it. I can get a loan from Fannie Mae and that's not a problem. So there's a whole bunch of like signaling issues both in the price and the requirements for flood insurance, which is mostly a national public product. So that's where I think there's a lot of changes that you can look on the horizon in terms of solutions will be changes in requirements, changes in the sort of grading of FEMA zones, and maybe getting rid of the FEMA maps entirely. That's been suggested by the GAO to Congress for the purposes of the required flood insurance purchase. So a lot of changes there, and there was a big revision of pricing in that program called Risk Rating 2.0 that rolled out in 2021, and that was a big first step for the National Flood Insurance Program.
Yeah, although that disincentivized people to buy it. And one of the other issues, you touched on it, are these insurers of last resort, the state-run Citizens, the California FAIR plans, because the reason people are moving there into that is because the prices are not risk-based prices. They're below the true risk. So you're encouraging actually people to live in hazardous areas. And interesting on the flood, I don't know if you know this, but Citizens in Florida, they were trying to depopulate this. So one of the things they did is they said, if you're in it, you have to buy flood insurance. So they were requiring people. And that just got so much pushback, they dropped it. It was like all of these things, they just get consumer pushback. So it's just, it's really hard.
One of the questions that's come in over the app is exactly on this topic. It's about, how do you balance the way that incorrectly priced insurance can subsidize people to live in areas where they can't truly afford to live with the climate risk, while also not pricing low income and vulnerable populations out of the most economically dynamic regions of the country, which are some of these places where everyone wants to go live. So how do we think about holding that tension?
Yeah, I'd like to say something about that because this is kind of an excuse that's given, but if you look in Florida at the coastal properties, this is not low-income housing. I mean, these are the biggest mansions, along the coast. So at least make those people pay the true cost of the risk, the people that can afford it. And then you separately deal with the low income people, the underserved communities to help them, but it's kind of this blanket spin. Well, we can't do that because, it'll hurt, underserved populations.
What
but
does that
that's
look like?
not-
What does that look like? How do you help the marginal populations? Because if you're helping them by, what does that look like?
Well, maybe we actually charge more. I mean, this just popped into my head. It was a great question. These, wealthy people that have, can afford to pay, first of all, the true risk-based premium. Secondly, maybe because they are able, you charge them a little more.
Cross-subsidized.
A little cross-subsidy to say, you have, you're able to live here, and then, use that to fund some other things. I mean, again, I'm not a politician, so I have no idea if this would ever fly, but it seems to me that there are people who can afford to pay who are not being forced to pay the true risk-based premium.
It's hard because you have a lot of people in this country, again, to Karen's point, that decide to move to these areas where they know they're exposed to these risks. And they complain the same way that people that are paying the same premiums for a much smaller house in some other areas where, when there wasn't this huge influx of building and this huge influx of people moving in, the prices were actually fairly flat and stable. Like I live in Austin, Texas. I bought my house in 2019. And I live in a one-story home in a nice community, West Austin, that I paid $1,000 a year for my home insurance in 2019 when I bought my house. I just renewed my policy in December. It's $5,025 was my renewal. So in 5 years, it's gone up by an additional $4,000. I can luckily afford my insurance premium, but I know a lot of areas around Austin where the people that live there that are low income do not have the capability to pay for the same insurance policy through a company like State Farm or Allstate or others and get the same access to the same types of coverages. So it's a compounding issue. And as you have more population migration of people moving into these areas, you start to mix other types of financial populations of retirees who don't fall into the same classification. And Florida sees this issue in a lot of their trailer park areas that they have of retirees from New York and the snowbirds. And so it compounds on so many levels and just becomes so problematic for the industry to try to price, especially when you're trying to price it with a regulator trying to keep you as flat as possible and as fair as possible and keeping everybody bucketed together when they're really, really, really not.
There's a couple of questions that have come up that may ask us to sort of stretch outside of the comfort zone here in terms of expertise. We've been talking a lot about buildings and homes and businesses. There's a whole stream of this conference which is about agriculture. And what does this look like in rural areas? Climate change is impacting crop feasibility, growing season, kind of going back to the earlier question that was asked. Is crop insurance something that can help us with climate resilience? Are there differences in the risks for agricultural lands than for what we might visualize as an urban or suburban context? Any light to shed here or sort of things to have in mind in those spaces?
I'm not an expert on agriculture, but I think that there are a lot of parametric solutions.
There are.
There aren't
There
there?
are.
It seems like this would be ideal.
It is. It actually, where parametrics started is really in the agricultural business. But I think the premise of that question, and I'll say this to Adaptive's first product around the grid reliability and grid resiliency, until we started truly investigating the power grid in the US, I never realized how much the farming industry actually relied on consistent power. Right? If a business goes down for a day and loses their revenue, they can make it back up pretty quick. In the agricultural industry, if you lose power to certain things on a day that it might be very, very cold or very, very hot, it can ruin your entire crop for an entire year. So you have a very small scale event that causes a mass magnitude impact on your business over the course of the next 12 months, which becomes very hard to price and is triggered off of something that is not necessarily easily modeled of like what the impact is, because you're thinking about the impact of temperature, but not thinking about the fact that that temperature rise or the new data center that was just built in the country near that farm is going to suck so much power off the grid that you're now going to have stability issues, which just kind of compounds this idea around resiliency and what we're putting into the investments that we're making in this space.
Are there situations where climate change may actually reduce premiums? For example, a flood zone getting drier? That's one of the questions that came through.
That'd be lovely.
We haven't found any yet.
Okay. You mean you don't look for places to reduce your prices?
I'll just, there's one, there are places, for instance, that may benefit from in-migration from places that are becoming too expensive. Unfortunately, the best attempt I've seen at this, and I'd actually reference this, the work of this one professor at Tulane, Jesse Keenan, who's just because he also did some really interesting work on climate gentrification. So the problem of like over-subsidizing for lower-income households is they're already not getting the same signals from the higher-income households, and so they're getting kind of stuck in the places that are most at risk. So people who can afford to move when they see the writing on the wall do, and the people who can't stay, and if you subsidize it, that makes it worse. But unfortunately, he did all this work and listed out, the 12 best cities that are most likely to benefit from a structural perspective from climate in-migration, and he had North Carolina, Asheville, like at the top of the list. I actually personally have some friends who left Northern California because of all the wildfire blackouts and all the constant shutdowns, and they moved to Asheville 2 years ago before Helene. And so I don't know, if folks who don't know, Helene was decimated by inland flooding.
I mean, I think that's an important point. What we don't realize, there are very few, if any, areas in the US that are not prone to severe weather, severe extreme events. I mean, so I don't know.
It's very unique.
Yeah, that map shows that, right? Like those billion-dollar disasters are.
Because you have tornadoes, you have hailstorms, you have floods.
Yeah.
It's just.
It's a cheery business to be in.
Yeah.
Yeah. It's a great business to be in for students who want a career that they could have and a path that could allow you to work on so many different things. When you think of the data science needs, the insurance aspects, like insurance is one industry for the world, and I think we saw this during COVID, where the insurance industry was essentially the financial unit that held the world afloat while everybody was stuck in their houses because we were still paying claims, still had people in the field doing their job and doing work. It's an incredible industry, and a lot of people don't realize the depths at which insurance stands up the world economy. You don't own a business without insurance. You own a car without insurance. You don't own a house without insurance. You don't travel typically without whoever you're traveling through having insurance. It's behind almost every single thing that you do in your daily life and is one of the most important pieces of like our financial stability as a society.
Yeah, it is very important, and it's also very exciting. I mean, because now, AI, machine learning are really being embraced in many different aspects, including catastrophe modeling. Of course, I think catastrophe modeling is the most exciting area of insurance. And by the way, I will say that the catastrophe models, they're not limited to insurance companies. I mean, they are used by banks, other financial institutions, municipalities could use them. So it's not, our modeling technology is not limited, but it's just that the needs are so great in the insurance industry for the models, and we have focused, as you know, on property damage and property losses, which, again, not agriculture and some of the other things, but they're readily adaptable, and the technology can be expanded to, any other areas where there's, extreme.
I think that's a really important point, and just because insurers are consumer households, voters' primary connection with their personal liability around climate change. That's my core thesis. And frankly, the only real way to mitigate this risk is through mitigation, less greenhouse gases. So, if insurers can help people become aware of their own personal connection from a financial standpoint to these risks, they might get behind the sort of grassroots movement we really need to transition. So.
Yeah.
What do you think are some of the most, on that line, Dave, what are some of the most progressive or exciting or transformational efforts that you've seen the insurance companies or financial sector maybe more broadly participating in to try to encourage that constellation of mitigation and adaptation efforts? Like, do you see, are there other places where there's spots of innovation or leadership that might signal what is possible beyond what we've tried so far?
AI and machine learning, to me, is going to have the most impact on insurance, I think, in the next 10 years. It's incredible just in the last 12 months how much the industry has started to embrace it, because it was an afterthought for a very, very long time. I think the regulators are actually starting to embrace it. The NAIC, which is the National Association of Insurance Commissioners, which is kind of a regulation body that kind of speaks to the industry on behalf of all the commissioners, is starting to have a lot more conversations about it, and the advancement that it can have in helping people do exactly what you just said, where I could run an analysis through AI on somebody's house and help them get a very clear picture of the things that they need to invest in, the things that they're exposed to, and actually help them understand how it's going to impact their life and what that's going to be like when they have a loss or when the next event happens. And when you think about it at all the different levels we've talked about today, like at the municipality level, right, with the cities, and new product ideas and new things, it's going to lead to a much larger influx, and hopefully it will reduce a bunch of the expense that insurance companies are having to pay internally, and hopefully insurance companies will take that savings and expenses that they're going to see from those technologies and actually invest them in ways to reduce risk and reduce loss over time.
I'd highlight a couple industry groups maybe that people can look into. So there's one I mentioned to you earlier, the Geneva Association, which is a global industry group of insurance executives that are kind of trying to put these pieces together around climate. And then another one is a newer one called Insurance for Good. So I don't know if you guys have heard of that, but it basically spun out of EDF, but it's another one where they're really trying to put all these pieces together for the insurance industry. I'm sitting here with insurers, so I don't want to do too much poking, but there's this whole new cottage industry of climate conditioned modeling applications, which is, historically a lot of, and I'll leave it to Karen to correct me, but a lot of insurance modeling work is based on an actuarial basis. So it just says, well, what is that property? Maybe its price has grown, its structural, its exposure has changed somehow, but the risk itself has been static. And now we know that is actually changing over time. So the history isn't necessarily the best view of the future. So there's this whole cottage industry that's taking these climate forecasts and integrating them. There's one that stands out called First Street Technology, and they have a website called riskfactor.com. And you can just put in your address and get all this cutting edge. It's cutting edge in this climate condition modeling world. It's probably not as cutting edge from a actuarial standpoint as anything coming out of.
Has anybody heard of First Street? Because I'd love to comment on that.
Yeah,
About what you said, First Street?
Yeah, First Street
Foundation, because I think there are a couple issues there that I find. First of all, the CAP, they do criticize the CAP models. Obviously, as I said, we have a lot of smart people. We also climate condition all of our models. We know we have to do that. We even have future catalogs out to 2050 that we're giving to insurers now, so they look. So we know all that. Right. But one thing we also know very well that First Street Foundation is ignoring is the great uncertainty. Okay, because these models get updated all the time. First of all, they disagree. Run all the 30 climate models. They'll give you different projections. So what is First Street doing? Which model are they using? How are they downscaling? Because these models, climate models, are pretty low resolution. How are they downscaling? And finally, the reason I think it's bad is they're assigning a score to a house. Now, an insurance premium, if our model is off a little, okay, so your premium might be 20% higher than it should be. But if they say your house is a bad score, you may lose like $100,000 worth of value, real estate value, right? Yeah. And when the climate model gets updated, that bad score house might end up being a good score house. And again, in insurance, there are a lot of things that go into the rate, not just our model, as I said, so it's there. But I think these have companies, some of them have a little bit too much hubris as to what they're doing, and they're all enamored with their models, and that's great. I'm enamored with our models, but I'm also very conscious of the great deal of uncertainty and variability and how those models are going to change. So these little insurtechs that are coming up, they don't know what they don't know, which is very dangerous, I think. But anyway, they're not.
Yeah. You don't want to see a climate risk score in Zillow.
Well, it's there though already.
It's there.
And it's really scary.
Yeah.
Hopefully, I don't think anybody's using it. That
sounds like a good
thing.
research project.
And they also say that they're nonprofit. They're nonprofit,
Not anymore.
but you get one for free, and then you have to start paying. So
This gets, this I think
there's a lot of funny stuff going on.
This gets back to where AI can be such a helpful tool. Like we use a number of different models that we look at and assess. We're not using them in our pricing right now. We're in a large research phase on what we feel has the most amount of impact, the most amount of benefit. And we can do a lot more because of AI. Like we can look at a lot more, we can do a lot more comparison, we can make a lot more decisions. The past is still a very good indicative of pricing the future of what's going to come, at least the understanding of what happened, right? Because that's the basis for an insurance company, is knowing if a hurricane hits X house, what is the amount of damage that I can expect from that wind loss? The industry knows that data from the amount of loss in the claim, and I can adjust that for price inflation for how construction materials go up, but it's an important piece. And there's a lot of unknowns, and this is the reason why regulators have fought against this for so long, because they want to be comfortable with the models that you're using to make sure that it's fairly pricing everybody, and that's what their job is. It just, it can slow down innovation sometimes, but I don't disagree. Having worked for a startup, like it's...
I don't want to say how many decades I've been in this, but I started when I was 10. These have the CAT models have been validated with tens of billions of dollars of actual claims data, and they evolved. The numbers changed over the years. They still change.
Yeah. So and I just wanted to highlight it for a couple reasons that I think it's an interesting area to watch in terms of innovation. One is you can't go on Redfin and get an insurance quote or even a score from your company, like anywhere else. So that like sort of democratization, you got to pay $30 for your report, but that's much less than you would have to pay a CAT modeling firm. So that's one thing that's interesting about it. The other is the CAT models that traditional insurance and that we're talking about here. They've been constructed to serve the insurance industry, which only takes risk 1 year at a time. And so the requirements, so you guys have this, and you probably have like the best thinking about it, right? Like how to do that out to 2050, but your clients don't really have that much use for it.
Well, they don't, but it's actually, this is another initiative now. There is the NAIC, there's a National Association of Insurance Commissioners. They are now asking insurers for those views. Right. So it's true, it's a one-year policy, but there is more awareness now that we do need to be looking to the future because it's not going to stay the same. As you said, Mike, it's not the same. The risk is changing. There is more of an acknowledgement of that now. Even again, the commissioners don't like it because it usually means risk is going up because we haven't found those places where it's going down. I'll keep looking. Yep. So you're right, and I think there has been, it was probably at Pennsylvania Wharton, Howard Kunruther, there have been studies on long-term insurance policies, but somehow they never took off. So,
it doesn't work.
Yeah, it doesn't work, okay.
Too expensive.
One of the questions says, Jason, you were right. I would never have guessed that a panel about insurance could be this interesting. So I'm glad that folks are still awake. We do, I think, have the opportunity to continue for a couple of extra minutes while we're waiting for Senator Markey. Okay. So let me just open the floor for questions for folks from the audience who would love to jump in. And yeah, go ahead.
About the carbon credits and when you were talking about the trees over the houses. So is there something like a policy that we could think of, with the government? So if you have trees and that's a liability for you, you will cut those trees. However, those trees have a value. Have you thought about that?
Well, no. I mean, I haven't thought about it. And again, it's not trees are bad. It's just too close to the house.
Karen Clark said,
Cut down all the trees. No, reduce your risk.
file risk,
No,
right?
and again, let me just clarify. It's not all trees. It's just the trees that are very close to your house that could fall on your house. That's all. And, you know, there are ways, I never thought of this before, but it's a good question. There are ways you could probably brace trees or something. I know I have a tree that we thought was falling over, so we, you know, braced it. So it's just the ones just near your house with the dead branches over it. And, you know, normally these are older trees, like that are, people never want to cut old trees down. I know that. I get that. We have a lot of trees around our house.
There are 2 points, though, on that are important. If you think about it from a residential community standpoint, there are communities, and this happens in fire-wise communities, of where trees should be planted, how they should be planted, how far they should be from structures, the types of trees that you're planting in areas of this country that are highly flammable when you're in a fire zone is probably not the most, you know, opportune investment to prevent a wildfire from hitting a community. But when you talk about decarbonization and green energy and other things too, that's more of a commercial industry thing. Right? When you think of all the data centers that are being built and companies that are trying to be carbon neutral in what they're doing, they're not planting trees in residential neighborhoods like what we're talking about to prevent losses in a residential community, right? They're planting it in a forest, or they're knocking down a forest to build a, you know, new data center. How are they going to actually replicate what they just removed from the environment to remain carbon neutral? There is a lot of investment. There's a lot of companies that have stepped up and are investing in technologies on how to do that the best.
Yeah, and one other thing I will say, you made a great point again about it's the nature of the trees. Because again, palm trees are pretty resistant to wind. They don't fall down. So maybe there are types of trees, there you go, that you could plant that are gonna not fall over that easily. I mean, that's a great point.
I'm glad we ended with we found ourselves to a pro-tree approach here at the end.
Green energy.
So thank you so much for making a panel on insurance super interesting and awesome. Join me, everybody, in thanking our panelists. Really appreciate you being here.